John, we've seen the Russell 2000 and the NASDAQ Composite at various points a while ago hit bear market territory, fall more than 20%. The S&P not so much. But then we have seen a recovery to varying degrees. We've seen the TSX, thanks to oil and gas and gold stocks, actually hit an all-time high recently. So you've been saying we're going to buy the dip, sell the rip kind of situation. So how do you define that as you're adding and trimming positions?
We sort of track the larger S&P 500 is sort of where we typically look to invest our money. And you know, it was off about 18% or so at the worst of the markets in early March. We're now up 10%. We're just, you know, 3% off the all-time highs again. And, you know, the markets have been adjusting to all kinds of different things: the interest rates, the economy, how much the Fed's going to raise, the war in Ukraine, what's Putin up to. And I think the volatility, I don't think the market's really paying all that much attention to what's going on in Ukraine, to tell you the truth. Clearly the war's still raging and the markets are just off their highs, and they're higher than when they were when the war broke out. I think the issue is that the central governments around the world, central banks around the world, are beginning to raise interest rates. And it's reasonable to think that they're going to continue to raise interest rates until they get to a restricted point. And that's raised the concern about whether we're going to have a recession. Now, this morning, they just announced the fourth quarter GDP growth, second revision, came out at 6.9%. So the economy is going to slow from that kind of a pace. That's just not sustainable. The question is, how much is it going to slow, and how much is inflation going to moderate over the next 1 to 2 years, and how much is the Fed going to have to try to raise interest rates, and to what effect is this slowing and rising of interest rates going to be, one, a competitive threat to stocks from an alternative perspective, and how much is corporate profitability going to be impacted from supply chain problems, inflationary problems, and a naturally slowing economy. So I think it makes sense, with all those things to worry about and talk about incessantly, that people are going to have a hair trigger. And so I think when people get overly pessimistic and you get stocks trading at good values, and there still are some good values out there, you buy them, and then if they get overly jubilant, and I don't think we're quite there yet, but we're probably getting close again, to begin thinking about taking some money off the table. So you're just sort of fine-tuning things a little bit.
Right. Now, a lot of investors believe that the worst is over, we've seen the bottom, and that's it. Others say, no, this looks like a classic bear market rally trap to me. Where do you stand in there?
Yeah, we don't do the bingo card calling of the markets that much, but you know, it didn't feel like the ultimate bottom. I've seen quite a few bottoms in my 37-year career, and it didn't really feel like the bottom. We were getting close, I think, but it just wasn't there. The panic wasn't there, and we've had a big bounce back in optimism. And I sort of go back to this whole question of, we just don't know how much interest rates are going to rise. We do know they're going to rise quite substantially, and we don't know how much the economy is going to slow down. And so I think there's enough uncertainty out there for a period of time for people to be cautious. And you know, on this bounce, you've seen the character of the buyers change. The long-term big pension funds, the long-term money, the steady Eddie guys, the kind of things like we do, they're not making a lot of investment decisions. This is a lot of fast money trading, a lot of hedge funds covering shorts. They were on the wrong side of this most recent bounce. So, and the volumes have been very low. So I don't think the conviction is super high.
You make a good point there that we probably haven't seen that ultimate capitulation, whereby it's a day or two where everybody's throwing in the towel and it looks really ugly. And we've talked over the past year and a half or so about these bubbles and mini bubbles. Most of them have popped, from SPACs to electric vehicles and so on. But there still seems to be these animal spirits, right? Because meme stocks, somehow, we thought they were shot and dead behind the barn. But, you know, we've got GameStop coming back and AMC coming back. So is potentially the worst over? And I guess I'm kind of asking the same question. But with all those animal spirits still out there, it can't be over, right?
I think the GameStop meme trading stuff is not going to go away, and it's not the major driver of the overall market behavior. It's one part of a casino. You know, I would equate it to the fact of, you know, people don't make money playing bingo, and yet they keep going back to the casino, so to speak. It's a good business. It's an interesting business. Some people make money. Some people are desperate to make money. There's been a whole theory that the market would probably run out of steam around tax time because these meme stock players have to pay their taxes and maybe they've lost their money in the intervening period. I don't know. I don't think it really matters all that much. Ultimately, stock prices on good quality companies are determined by profitability. The mood swings in terms of how much we value those profits up or down, but the long-term trajectory is positive. And I think the reason why the markets are reasonably optimistic right now is because economic growth is very, very strong. And the calls for a recession are probably premature because you're not going to go from 6.9% growth to negative growth overnight, but what you may see is a rapid deceleration.
A few weeks ago on Uncommon Sense Investor, we were putting up some posts about the potential for an inverted yield curve, and that storyline and narrative has come more into the mainstream lately. And we know that just yesterday, as we sit here, we did see that the 2-year yield go above the 10-year in the U.S. just very briefly. 2-year representing higher rates from the Fed, the 10-year representing some concerns that this growth you're talking about may slow down meaningfully. The one thing is that the 2 and 10 yield curve inversion has presaged 6 of the last 7 recessions in the U.S. since 1978. So that seems like a pretty good track record. How seriously do you take that? Or are you looking at just the whole picture and you can't focus on one thing too much?
I think if you don't pay attention to what the cost of money, interest rates are, if you don't pay attention to one of the biggest markets in the world, you do so at your peril. Ultimately, when you're valuing companies, you have to use some kind of a discount rate. So the price of interest rates is very important. There's an argument about whether you use 2 years, 10 years, or 3 months versus 10 years. And I think it makes sense that you look at the 3-month versus the 10-year, and that's actually gotten steeper, and that's one of the arguments or justifications as to why stock prices have gone up right now. I don't know. You're talking about the last 2 weeks worth of trading, or 3 weeks worth of trading. I'm not overly convinced that the collective wisdom of the bond market these days and inverting the curve is just a reflection of people making bets a year or 2 down the road. And those bets may or may not be right. I think there's reason to believe, they're also to some extent betting on the fact that inflation is going to moderate. And because quite frankly, raising interest rates to 4 or 5% right now is not going to make gasoline prices go down. It's not going to make the farmers in Ukraine be able to plant crops in their fields. So, I think the markets are really grappling with how much are rates going to really rise, and they may not rise all that much. It doesn't mean we're going to have a recession. An inverted yield curve does not cause a recession. 70% of the economy is driven by consumer behavior, and the consumer, other than hearing it on the news, doesn't know or care about what the yield curve is doing on any given day.
The Federal Reserve is expected, based on the numbers, to hike rates as many as 8 times this year. Is there any way possible the Fed could actually do that 8 times and maybe even 50 basis points a couple times starting in May? Or will we see a market revolt like we did in 2018, where the stock market just kind of said, no, it's getting too much, we can't deal with it, and the Fed has to pivot and change course?
I think one of the really important things to understand is the Federal Reserve Board does not care what the stock market does.
You don't think
That's
so?
not their mandate. No, I don't think so. Their mandate is to promote economic growth and to maintain a reasonable rate of inflation. The stock market reflects a portion of the economy's economic activity, but it's not the only thing that takes place. Billy, who runs a pop stand, is not part of the stock market, but it's real economic activity. And the other thing I think that's really important to put into consideration is that the market's already anticipating the Fed funds rate going to 2%. We're at 0.25% right now. So why don't you just get it over with and go to 2?
In one shot?
One shot. I mean, the bond market's already there.
Yeah.
And, it would cause mayhem for a day or 2. But everyone expects it. The economy's booming. We're at 6.9% growth, and the federal funds rate's at 0.25%. It's just too low. So go 50 basis points, go 75, or do 2 50s and do 450s and get it over with so we can stop talking about it and get
Right.
focused on something more practical with regard to the real world.
But you know the Fed wouldn't want to shock the market that way unless they really telegraphed it, right?
They're getting more and more aggressive, and the market's already there. And you know, it's funny because the market was saying beforehand that the Federal Reserve Board was behind the curve, and then all of a sudden the Federal Reserve Board in February started getting more hawkish, and this 50 basis point was on the table, and then the market lost its mind and started falling a little bit in early March. Now the market's way ahead of the Fed again, and I think it's a matter of time until people start saying, yeah, we're going to do a couple of 50s. I think, you know, they're even talking about doing 250s in Canada now. That's where the Canadian dollar's been very strong recently. I think they should just get it over with and do it. The economy's strong, inflation's high. Some of that's reflective of a strong economy, and some of it's reflective of supply chain disruptions. But if we're at 6.9% growth, raise interest rates, get it over with.